Imagine waking up on a quiet Tuesday morning in Brisbane. You make yourself a cup of coffee, check your phone, and notice that money has landed in your investment account overnight. You didn't work extra hours, you didn't sell anything, you didn't even open your laptop. While you were sleeping, your investments quietly paid you. For many Australians, that's the definition of financial freedom. Not becoming a millionaire overnight, but building an income stream that keeps showing up month after month without relying on a paycheck. But here's the question almost everyone asks. How much money do you actually need invested before your dividends can pay for your lifestyle? Is it $500,000, $1 million, or is it much more than people think? The answer might surprise you because Australia has one advantage that many other countries don't. It's called franking credits, and they can make dividend investing far more rewarding than many beginners realize. Unlike many overseas markets, Australian investors can often receive extra tax benefits when they own dividend-paying companies. That's one of the reasons dividend investing has become such a popular strategy for Australians planning for long-term financial independence. However, there's also a lot of misinformation online. Some people believe they can simply buy the highest-yielding shares and retire early. Unfortunately, that's one of the fastest ways to damage a portfolio. In this video, we'll break everything down step by step. We'll calculate how much capital you realistically need, explain how taxes affect your income, look at the best ways to build a dividend portfolio, and reveal the common mistakes that stop many investors from reaching financial freedom. But before we start calculating those numbers, you first need to understand why Australia's dividend system is so powerful and why investors in many other countries wish they had it. That's coming up next. Why franking credits give Australian investors an edge. So what exactly makes Australia's dividend system different from the rest of the world? The answer is a feature called franking credits, and once you understand how it works, you'll see why so many long-term Australian investors love dividend-paying shares. Here's the simple version. When an Australian company earns a profit, it usually pays company tax before distributing any money to shareholders. In many countries, that's not the end of the story. Investors receive the dividend and then pay tax on that same income again, meaning the profits are effectively taxed twice. Australia takes a different approach. Through the dividend imputation system, eligible shareholders receive franking credits that recognize the tax the company has already paid. Depending on your personal tax situation, these credits can reduce the amount of tax you owe, or in some cases, even result in a refund. That's a major advantage that many overseas investors simply don't enjoy. For example, if you compare two portfolios with the same advertised dividend yield, an Australian investor may end up keeping more income after tax because of these credits. Over years or even decades, that difference can become surprisingly significant. Of course, this doesn't mean every dividend stock is automatically a great investment. A healthy dividend is only valuable if the business behind it is financially strong and capable of continuing those payments year after year. That's why experienced investors don't just chase the biggest dividend yields. Instead, they look for companies with reliable earnings, sustainable cash flow, and a history of rewarding shareholders consistently. Now that you understand why Australian dividend investing has such a unique advantage, it's time to answer the biggest question of all. How much money do you actually need invested to replace your salary and live comfortably on dividend? The numbers might be lower or higher than you expect, and that's exactly what we'll calculate next. How much do you actually need invested? Now comes the question you've probably been waiting for since the beginning of this video. How much money do you actually need before your investments can cover your living expenses? The answer depends on one thing: the lifestyle you want to live. Not everyone has the same financial goals. Some people are happy with a simple, comfortable lifestyle, while others dream of frequent holidays, dining out every weekend, and upgrading their car every few years. There's no right or wrong answer. The important thing is knowing your target before you start investing. According to retirement spending estimates in Australia, a single person living comfortably may need around $54,000 a year, while a couple may require roughly $77,000 annually. That level of spending generally covers everyday living costs, transport, healthcare, occasional travel, and the freedom to enjoy life without constantly worrying about money. If your lifestyle is more modest, your annual expenses could be significantly lower. On the other hand, if you're aiming for a premium lifestyle with overseas holidays and higher discretionary spending, your target income could easily easily exceed $100,000 per year. So let's turn those income goals into investment targets. A diversified Australian dividend portfolio can often generate an effective yield of around 5.5% when franking credits are taken into account. While actual returns will vary from year to year, this provides a reasonable estimate for long-term planning. Using that assumption, to generate $50,000 a year, you'd need approximately $910,000 invested. For $75,000 per year, the target rises to about $1.36 million. To receive $100,000 annually, you'd need around $1.82 million invested. And if your goal is $150,000 each year, your portfolio would likely need to be close to $2.7 million. At first glance, those numbers might seem intimidating, but here's something many people forget. Very few successful investors build portfolios like these by saving every dollar themselves. Most achieved them gradually through years of consistent investing, dividend reinvestment, and the incredible power of compound growth. In other words, your monthly investing habit matters far more than trying to become rich overnight. And that brings us to the biggest advantage ordinary Australians have. You don't need to start with hundreds of thousands of dollars. You simply need a plan, consistency, and enough time for compounding to work. In the next part, we'll calculate exactly how long it could take to reach your first million and why taxes can make a bigger difference than most people realize. The secret isn't saving millions, it's letting time do the work. Here's the good news. You don't need to have $900,000 sitting in your bank account before you can start investing. In fact, almost nobody begins that way. Most successful investors build their portfolios one contribution at a time, allowing compound growth to do the heavy lifting over many years. Let's look at a simple example. Suppose you invest $1,500 every month into a diversified Australian share portfolio. If that portfolio earns an average total return of around 8% per year over the long term, you could grow your investments to roughly $900,000 in about 19 years. Increase your monthly investment to $2,000, and you may reach the same milestone in approximately 17 years. The lesson isn't that you need to invest huge amounts overnight. The real takeaway is that starting early is incredibly powerful. Every year you delay gives compounding less time to work its magic. But building wealth isn't just about investment returns. You also need to think about tax efficiency. Australia's tax system gives dividend investors several advantages, especially when franking credits are involved. Depending on your personal income and tax bracket, those credits can reduce the amount of tax you owe on dividend income. For some investors with relatively low taxable income, they can significantly improve the amount of money you keep after tax. Another strategy many Australians use is splitting their investments between superannuation and a regular brokerage account. Investments held inside super can benefit from concessional tax rates during the accumulation phase, and once retirement conditions are met, earnings in the pension phase may become tax-free under current rules. Meanwhile, an investment portfolio held outside super provides flexibility, allowing you to access your money before reaching preservation age. Many long-term investors combine both approaches, using super for maximum tax efficiency while building a separate portfolio that can generate income earlier in life. The key is not choosing one over the other, but understanding how each account can play a different role in your financial plan. But even if you build the perfect portfolio, there's one mistake that destroys more dividend investors than market crashes ever do. It's the temptation to chase the highest dividend yield. In the next part, we'll explain why that strategy often backfires and how experienced investors choose dividend stocks that can keep paying for decades. Avoid the biggest dividend investing mistake. By now, you know roughly how much money you'll need and how consistent investing can help you get there. But before you rush out to buy the highest paying dividend stock you can find, there's something you need to know. One of the biggest mistakes new investors make is believing that a higher dividend yield automatically means a better investment. In reality, that's often the opposite. Imagine you come across a company offering a dividend yield of 10%, 12%, or even higher. It sounds amazing, right? But in many cases, that unusually high yield exists because the company's share price has fallen sharp. The market may already be expecting weaker profits, financial trouble, or even a dividend cut. That's why experienced experienced investors don't focus only on today's yield. They pay much closer attention to the quality of the business. Companies with strong balance sheets, reliable earnings, and a long history of rewarding shareholders are usually far better choices than businesses promising eye-catching payouts that may not last. In Australia, many investors look toward established companies such as the major banks, Wesfarmers, Telstra, Woolworths, leading insurance businesses, and resource companies during strong commodity cycles. These businesses aren't always exciting, but consistency is exactly what dividend investors are looking for. Of course, not everyone wants to research individual companies. That's where dividend-focused ETFs become incredibly useful. Instead of buying dozens of shares one by one, a single ETF can instantly give you exposure to a broad range of Australian companies. Popular options include VAS, which tracks a large portion of the Australian share market, IOZ, which also provides broad ASX exposure, and income-focused funds like Beta Shares INCM. These funds offer diversification, lower maintenance, and can reduce the risk of relying too heavily on one company. Another benefit of ETFs is simplicity. You don't have to worry about constantly monitoring individual businesses or deciding when to replace underperforming stock. The fund manager handles most of that work, making ETFs an attractive option for busy investors. It's also worth understanding when your dividend income actually arrive. Most Australian ETFs distribute income every quarter, while many ASX-listed companies pay dividends twice each year. Because different investments pay at different times, many experienced investors intentionally mix ETFs and individual shares to spread their income more evenly throughout the year. Some even create a dividend calendar, arranging their holdings so cash payments arrive almost every month. This can make living off investment income feel much more like receiving a regular salary. But even the strongest dividend portfolio has one enemy that never disappears: inflation. If your income doesn't grow over time, your purchasing power slowly shrinks. In the final part, we'll look at how successful investors stay ahead of inflation, use dividend reinvestment plans to supercharge their wealth, and bring everything together into a practical roadmap for achieving dividend freedom in Australia. Beating inflation and building dividend freedom. There's one final challenge every long-term investor needs to understand, and it's something you can't see happening day to day. It's inflation. Even if your portfolio generates enough income today, the cost of living won't stay the same forever. Groceries become more expensive, fuel prices change, utility bills increase, and the lifestyle that costs $50,000 a year today could require significantly more money a decade from now. That's why successful dividend investors don't just focus on collecting income, they focus on growing that income. Many of Australia's strongest companies have a long history of increasing their dividends over time as their businesses expand. While there's never a guarantee that dividends will rise every single year, financially healthy companies often increase shareholder payments over the long term. That means your dividend income has the potential to grow alongside your portfolio, helping you keep up with inflation instead of falling behind it. Another powerful strategy during the wealth-building phase is using a dividend reinvestment plan, often called a DRP. Instead of receiving your dividends as cash, you can choose to automatically reinvest them into buying additional shares. Those extra shares then generate their own dividends, which purchase even more shares in the future. It's a simple idea, but over many years it creates an incredible compounding effect. Think of it like rolling a snowball down a hill. First, the growth seems slow, but as the snowball gets bigger, every rotation collects more snow than the one before. Your investment portfolio works in much the same way. The larger it becomes, the faster your dividend income can grow. Eventually, there comes a point where many investors decide to switch from accumulation to income. Instead of reinvesting every dividend, they begin receiving those payments as cash to help cover everyday living expenses. By that stage, your investments are no longer just numbers on a screen. They're working like a personal income-producing machine. So, what have we learned? Living off dividends in Australia isn't about finding a secret stock or getting lucky with the market. It's about building a diversified portfolio, investing consistently, taking advantage of Australia's unique tax benefits where appropriate, avoiding risky high-yield trap, and giving compound growth enough time to work. For many Australians, replacing their salary with dividend income may require somewhere between $900,000 and $1.8 million, depending on the lifestyle they want. That goal may sound ambitious today, but every large portfolio starts exactly the same way, with a single investment and the decision to stay consistent. The biggest mistake isn't starting with too little money, it's waiting too long to begin. Imagine looking back 10 or 20 years from now and realizing that the investments you made today are paying for your holidays, your groceries, your retirement, or simply giving you the freedom to spend more time with the people you care about. That's the real power of dividend investing. If you found this video helpful, don't forget to hit the like button because it helps this channel reach more Australians who want to build long-term wealth. Subscribe for more practical videos on investing, passive income, ETFs, and financial freedom, and turn on the notification bell so you never miss a future upload. Thanks so much for watching, and until next time, keep learning, keep investing, and let your money work just as hard as you do.